We have talked about currencies. We have talked about synthetic baskets. We have talked about spreads. Now, we are going to talk about something that operates quietly in the background of almost every significant currency move. Something that most short-term traders completely ignore. But once we understand it, we will start to see it everywhere. We are going to talk about bonds and yields. Let us start right at the beginning. What is a bond? Forget trading for a moment. Think about everyday life. Imagine a friend comes to us and says, "I need to borrow $1,000. I will pay you back in full in 2 years. And every year while I have your money, I will pay you $50 just for lending it to me." We think about it. We trust our friend. We hand over the $1,000. We have just made a loan. Now imagine a government doing exactly the same thing. A government needs money. Maybe to build infrastructure. Maybe to fund public services. So instead of going to a bank, it goes to investors. It says, "Lend us money. We will pay you back in full after a set period of time. And while you hold our debt, we will pay you interest." That agreement, that promise, is a bond. The government is our friend. The investors are us. The interest payments are the reward for lending. Now let us talk about the yield. In our friend example, we lent $1,000 and we received $50 per year in return. $50 on a $1,000 loan. That is 5% per year. That 5% is the yield. The yield is simply the return we receive for lending our money, expressed as a percentage. So far, so straightforward. Bond, a loan to a government. Yield, the return we get for making that loan. Now here is where it gets a little more interesting. And this is the part that confuses most new traders. Bond prices and yields move in opposite directions. When bond prices go up, yields go down. When bond prices go down, yields go up. Always. Without exception. Why? Let us go back to our friend. We bought that bond for $1,000. It pays us $50 per year. Our yield is 5%. Now imagine we want to sell that bond to someone else. But since we bought it, interest rates have risen. New bonds are now being issued, paying $80 per year. Nobody in their right mind will pay us $1,000 for our bond, when they could buy a new one paying $80 instead of $50. So we have to sell our bond at a discount. Let us say we sell it for $700. The new buyer pays $700, but the bond still pays $50 per year. $50 on $700 is now a yield of over 7%. The price went down. The yield went up. Think of it like a seesaw. Bond price on one end, yield on the other. They are always connected. When one end goes up, the other end must come down. They cannot both move in the same direction at the same time. Price up, yield down. Price down, yield up. This is one of the most fundamental relationships in all of financial markets. And once it clicks, it never leaves us. Now let us talk about why this matters. Because bonds and yields do not exist in isolation. They are deeply connected to currencies. And this connection is another one of those intermarket relationships we explored in Chapter 3. Another pipe in the system. Remember in Chapter 3 we said that money is always moving, flowing from one market to another, seeking the best return, seeking safety, seeking yield. Here is the key question that every large investor in the world is constantly asking. Where should I park my money to get the best return? And one of the most important answers to that question is government bonds. Imagine we are a large institutional investor. We have billions of dollars to place. We are looking at two countries, Australia and the United States. Australian government bonds are currently offering a higher yield than US government bonds. Where does our money go? Australia. We buy Australian bonds. To buy Australian bonds, we need Australian dollars. So we sell our US dollars. And we buy Australian dollars. What just happened to AUD/USD? Demand for Australian dollars increased. Demand for US dollars decreased. AUD/USD goes up. Now flip it around. US bond yields rise sharply. Suddenly, US bonds are offering a better return than Australian bonds. Where does the money flow now? Toward the United States. Investors sell Australian bonds. They buy US bonds. To buy US bonds, they need US dollars. So they sell Australian dollars and buy US dollars. AUD/USD goes down. This is the bond and yield connection to currencies. It is not complicated. It is the same principle as everything else we have learned. Money flows toward the best return. And when money flows toward a country, demand for that country's currency rises with it. Now let us bring this back to our AUD/USD example. We now have multiple layers of information telling us about this pair. In Chapter 5, we built two synthetic baskets. One tracking AUD strength across multiple correlated instruments. One tracking USD strength across multiple inversely correlated instruments. And in Chapter 6, we learned to look at the spread between them. Now we can add another layer. Australian bonds and yields tell us something about AUD. When Australian yields are rising, money is being attracted to Australia. AUD is likely to strengthen. US bonds and yields tell us something about USD. When US yields are rising, money is being attracted to the United States. USD is likely to strengthen. Each of these is a separate signal, each one giving us a piece of the picture. The synthetic baskets, the synthetic spread, the bond and yield picture for each country. All of them intermarket relationships. All of them different pipes in the same system. All of them telling us about the same underlying thing. Where is money flowing right now? And what does that mean for AUD/USD? We are building a complete picture, layer by layer. And in our next chapter, we are going to take the yield concept one step further. Just as we created a spread between our two synthetic baskets, we can create a spread between the yields of two countries. Australian yields minus US yields. One line, capturing the net yield advantage of one country over another, and showing us, in real time, which direction that advantage is pointing. See you in the next chapter.